First of all, we had a weak 3-year Treasury and 10-year Treasury auction today, so I think that probably was a little bit of a tripwire. But I don't think there's any surprises baked into the cake here. It's pretty clear the Fed is continuing to move along this path. The so-called neutral rate, they often discuss it. They don't know exactly where it is. Powell's made that pretty clear. They're likely to pass through where they think it was, which is the 3% level. We're getting close to that. We have a ways to go. So I think it's very almost conceited of market operators to blame this on the Fed. There are no surprises here. And by the way, they can thank the Fed for having turned the market at 666, the devil's number, in March of 2009. It's been on a run since. We had a great year last year. The S&P was up, 20% or so. So I don't think it's fair to blame it on the Fed. And were I sitting at the policy table like I did for 10 years, I'd be saying we need to continue to gradually tighten because we're seeing some wage price pressure begin to develop now. But more importantly, we need to have, as I like to say, some nuts in the tree to give back for when the economy begins to turn, and we haven't seen evidence of that yet.
Yeah, I mean, and you've been warning, Richard, that it's going to be, not the easiest transition to go from a world of easy money back to normal. No. So that's what this could be. But I'm really glad that we have you because I know you know the current Fed chairman, Jay Powell, and you know former Fed chairman, Janet Yellen. And you know there was this idea of the Yellen put, that whenever the markets threw a huge tantrum, the Federal Reserve would look at it and may even pause or rethink the direction of where they're going or how fast they're going. Do you think that Fed Chairman Powell has a stomach to handle these kind of sell-offs and this kind of jump in rates?
Probably a stronger summit rather than his predecessors did, although I was with Janet on Monday night, and we talked a little bit about this. She feels very strongly that there should not be a put. She made a very good point in our conversation. I don't want to violate her confidence, but several people have been saying this, which is the market went up as rates were kept low for a long time. It's only reasonable that as rates go up, the market should adjust the way they discount future cash flows to present value. So, Jay Powell comes from the credit market side. He came up from Dillon Reed all the way up circuitously as a lawyer, et cetera, into the capital market side through his private equity firm. And I know him well. I think he has a better constitutional sense of the way markets operate. He's not a theoretical economist. He often refers to this as a risk management exercise, and I think he's probably much more tolerant. If you go back and look at the records of what he said in his first meeting of June of 2012, it was that we had to be very careful here because we're creating a one-way street, taking vol out of the market, and this could create a trap later on. So I do think he's just coming from his different background. It's not a matter of sophistication. It's a matter of what you understand. Markets come and go, and the Fed has underwritten markets for a long time. He made that very clear in his second press intervention, which was our job at the Fed, quoting him, is not to underwrite the equity markets. Their job is to underwrite the economy, provide liquidity necessary to create full employment, where we're presently far beyond full employment, and also to keep inflation at bay, which they seem to be doing rather well.
Mike, do you think if we did get any kind of comment from the Fed that hinted that they're watching this and that they're not as guaranteed to rise rates in December and next year, that the market would embrace that to the upside?
It would probably be taken as a net positive, I think.
Although Richard said don't bank on that.
No, I don't know that you're necessarily going to get that, but I do think that the market today, just today, as the selling really did get intense, started to try and take back some of the expected Fed rate hikes for next year in terms of the futures positioning. So it shows you that there is some level of market upheaval that potentially would have the Fed change its mind, but I don't think we're there yet.
I mean, it was down. It was an ugly day, but you're down 3.5%. You're probably down about 5-6% overall from the highs. So, I mean, this is hardly something to get really freaked out about. Now, look, if this continues for several days and it really gets out of control, and it does feel like it's more problematic for sentiment, consumer sentiment and business sentiment and confidence and that sort of thing. And that's obviously going to be something that you have to monitor. But for now,
but Stephanie, this is the worst day for the NASDAQ since Brexit. That's significant.
Well, I'm not saying it's not significant, but think about how much it's up since Brexit. Yeah. I mean, it's up a lot.
Well, and you remember where the 10-year was the week after Brexit, 136.6. Now it's pushing around the 320 level. So, again, I don't see anything unnatural here, unless it, as you say, if it were to continue and begin to infect the economy, infect confidence, et cetera. We don't know. And that's only, the Fed will only move when market perturbations, volatility, corrections, whatever you want to call them, are perceived as infecting the real economy. Because they have a job.
Can I just mention something about the consumer? I mean, that's such a big part of the economy. It's 75% of the GDP. So I always obviously look at all different signs. Well, after the close, we had Costco reporting same-store sales at 7.3% growth, and it beat handily for expectations. So I'm going to just throw out a stat, like a data point.
That's helpful.
And I think it's important to remember that the economy is strong. We're in a good place for the Fed to do what they're doing, as long as they don't overshoot, and that's what we're kind of obsessing about.
So Richard, I guess final word to you then. We have been talking about this strong economy, not just the consumer, the labor market. I mean, lowest unemployment rate since the 60s. So how much can it withstand? And is it too premature to talk about slowing growth?
I think it's a little premature. I would also look at the NFIB data and how strong it was in its reporting, how strong it has been, and the strongest in 45 or so years. That database, by the way, those small, medium-sized businesses represent overall 51 or 50% of all U.S. workers. So if they're feeling strong about the economy, they're willing to commit capital to the economy, if they're willing to risk growth and hire more people, that will affect, you're right, consumer is the key variable in the GNP or GDP equation. So here's the thing. Don't expect the Fed to deter from their path until they feel, or unless they feel, that the real economy is weakening. They are not driven by what happens in the stock market, and they should not be, unless it infects the real economy. So that's where we are right now. I appreciate having the last word. I haven't had the last word in an awful long time, and I'm really grateful.